Welcome to the PAI Morning Briefing. I'm your host from PantheonAI, and today is February 25, 2025. Good morning, everyone. I hope you're ready for an in-depth dive into the markets, some intriguing news, and plenty of insights that we can all learn from. So grab your coffee, settle in, and let's get started.
Let's begin with a quick market overview. This morning, major indexes have been showing some interesting dynamics. While I don't have every single tick of information, the overall sentiment has been a mix of cautious optimism and measured recalibration. The NASDAQ Q in particular has been struggling as it trades below its 100-day moving average. It's been a rough 4 days on the downside, with the index slipping below the moving average level of 19,212.78, now sitting at around 19,138.56. That represents a decline of 147 points, or roughly 0.7%, a move that has certainly caught the eye of both technical analysts and swing traders alike.
Even though the broader market trends remain a bit elusive in today's fast-paced environment, we still see familiar patterns emerging in our favorite assets like Bitcoin and Ethereum. While I don't have the exact figures to recite off the cuff this morning, these digital heavyweights are continuing to experience their usual bouts of volatility. Many investors believe that these cryptocurrencies, much like the traditional markets, are trying to find a stable ground, albeit with all the zest and unpredictability that you would expect. I often compare their movements to that of a rodeo bull, exciting but not for the faint of heart. So if you're riding the crypto wave, make sure your seatbelt is fastened tight.
Now, shifting gears a little deeper into the major market trends, one of the dominant ideas circulating around is the growing divergence between technology stocks and the more traditional industries. On the one hand, you have tech giants who, despite their occasional wild swings, continue to drive innovation and shape the future of commerce. On the other, we have sectors like consumer discretionary and industrials that seem to be playing catch-up, affected by both macroeconomic headwinds and shifting consumer sentiment.
This divergence is underscored by patterns we're seeing with the NASDAQ's outlook. When a major tech index starts trading below its key technical levels, like the 100-day moving average we just discussed, it typically signals that some profit-taking or tactical repositioning is underway. It's almost as if investors are asking themselves, is now the time to exit or double down? In these moments, seasoned traders are watching the charts closely for any signs of reversal or confirmation of a longer-term bear trend.
One notable trend I've been paying attention to is how these technical patterns are starting to influence investor psychology. When the charts don't quite match up with the fundamentals, you start to get these very human moments where fear and greed collide. And that collision, my friends, gives us opportunities if you're willing to dive deep and look beyond the noise. For instance, a lot of analysts are cautioning that while this correction might be unsettling, it could equally serve as a necessary pause before the next upward surge. It all depends on whether the key drivers behind the tech sector, like cutting-edge innovation and robust consumer demand, can reassert their momentum.
Let's now take a comprehensive look at the important stories shaping our economic narrative today, starting with our headline about the NASDAQ. As I mentioned, the tech-heavy NASDAQ index has been on a streak, and trading below its 100-day moving average is a technical signal that can't be ignored. This isn't an isolated event, rather, it's part of a broader picture where investors are becoming increasingly cautious. Technical barriers are being breached, and while that might set off alarm bells in some corners, others see it as a potential setup to accumulate shares at a lower entry point. Just like a seasoned bargain hunter waiting for the right moment, many institutional investors are watching this space very closely.
Moving on from the tech-centric narrative, another story that's caught significant attention is the shift in Tesla's performance across Europe. Reports indicate that Tesla's sales slid by nearly 50% at the start of this year across the European region. Now, that's a headline that raises a few eyebrows, especially for those who believe in Tesla's relentless upward trajectory. In contrast to that decline, overall battery electric vehicle sales in Europe did see an impressive rise of 34%, with competitors like Volkswagen and SAIC Motors successfully expanding their market share. It leaves us pondering whether Tesla's dip is an isolated branding or execution issue, or if perhaps it's a sign that European consumers are diversifying their loyalty towards other automakers offering similar green credentials. It's almost like watching a dramatic automotive reality show where no one figure holds the winning ticket for too long.
The takeaway here is that market dynamics are shifting, and it's not enough to rely on past performance.
Let's talk about another story that's been making the rounds. Krispy Kreme's stock heading for what some analysts are predicting could be a record low. The company reported its fourth quarter results between the market opened, and early indicators suggest that earnings might continue to disappoint. Here's the twist. While some would say that a dip in expected earnings is just bad news for the company's stock, others argue it represents a temporary hit-up in an otherwise strong brand legacy. It reminds me of those times when your favorite donut shop experiences a minor setback. You still love the donuts, but you might take that as a sign to keep an eye on management's plan for getting back on track. It's a question of perspective. Do you see a once-in-a-generation turnaround opportunity, or do you see a brand struggling to adapt to changing consumer tastes in an evolving economic landscape?
Speaking of consumer sentiment, let's not overlook the news that consumer confidence has sunk to an 8-month low. The public seems to be grappling with worries about rising inflation and the uncertainty surrounding Trump tariffs, meaning that many are rethinking their purchases and tightening their belts. Earlier, we saw a post-election rally in consumer sentiment, but that high now appears to have faded away amid macroeconomic uncertainty and rapid policy changes from the new administration. The shift in confidence levels isn't just a statistical blip, it has real implications for everything from retail sales to the housing market. Consumers, after all, are the fuel that keeps the engine of our economy running. When they start to worry, the ripple effects can be felt across the board. It's like watching a once bustling diner slowly quiet down at the end of a hectic day.
Another significant item on our agenda today comes from the central banks. Dallas Fed President Lori Logan has expressed support for shortening the maturity of the central bank's balance sheet by tweaking the composition of secondary market purchases of Treasury securities. Essentially, what this means is that the Fed is thinking about aligning its portfolio more closely with the government's maturity profile, which could have wide-ranging implications for liquidity in the markets. This isn't just academic talk. Changes like these can influence interest rates, the cost of borrowing, and even the yield curves that we all keep a keen eye on. Reforming the balance sheet in such a methodical way might be seen as a proactive step to inject stability and predictability into an otherwise volatile market landscape. Of course, as with any central bank adjustment, market reactions can be fast and sometimes unpredictable, so it's a space worth watching closely.
In corporate news, there's a fascinating announcement from Davis Commodities Limited. The firm, in a move headlined by ambition, is set to acquire up to 49% of the share capital in Carfax Commodities Asia Private Limited. This stock acquisition plan underscores an ongoing trend of consolidation and strategic repositioning in the commodity sector. The idea here is to create synergies that can unlock new value, particularly in a market where supply chain disruptions and global trade dynamics are constantly at play. When a company like Davis Commodities decides to take a major stake in another entity, it signals confidence in the long-term prospects of that segment. It's like buying a substantial share in a promising startup. The expectation is that the combined entity will be far more resilient and dynamic than its parts.
Now let's pivot to another thought-provoking headline that you may have found as interesting as I did. Looking forward to the great wealth transfer, expect an $84 trillion mess instead. This compelling piece of analysis suggests that without proper estate planning, a significant portion of wealth could end up lost to legal fees and taxes. The so-called wealth transfer that many have been anticipating might not be as smooth and seamless as projected. Instead, without a robust strategy in place, the inevitable transition of assets might result in a labyrinth of legal and fiscal complexities. This isn't just a topic for high net worth individuals, it's a wake-up call for anyone who's thinking about intergenerational wealth and legacy planning. Imagine all that wealth swirling around in a legal vortex instead of being channeled effectively to the next generation.
It makes you wonder, are we underestimating the importance of a solid estate planning strategy at a time when economic circumstances are evolving so rapidly?
In an equally important policy-related piece of news, there's an update regarding the child tax credit. Parents on the lookout for some fiscal relief might be pleased to know that they can still claim up to $2,000 per child under the current arrangement. However, experts warn that this amount may drop once we pass the year 2025, unless Congress takes further action to extend the expanded version of the benefit. This brings up some significant questions for families planning their finances for the medium to long term. What happens to the disposable income that many households have come to rely on? And how might this fiscal tightening affect consumer spending, which, as we all know, is a major driver of economic growth? It certainly underscores the important interplay between public policy decisions and private sector expectations.
In the pharmaceutical arena, Eli Lilly has made headlines by cutting the price of its weight loss drug Zepbound for self-paying patients. The company is not just stopping at a price adjustment, it is also urging insurers and federal programs to recognize obesity as a chronic disease, thereby facilitating broader coverage. This move by Eli Lilly is a classic example of a company adapting its strategy in response to market and societal needs. Lowering the price can potentially open the door for more patients to access treatment, while the broader policy ask might reshape how chronic conditions like obesity are managed from a coverage perspective. It's an intriguing intersection of healthcare policy and corporate strategy, a space where the right price move could literally change lives and balance sheets.
Lastly, let's touch on a news tidbit from the tech world. HashiCorp, the enterprise software firm known for its solutions in cloud infrastructure, has seen its stock gain after a notable development. The United Kingdom regulator has approved the deal between IBM and its targeted assets. While the details of the acquisition deal are still unfolding, this regulatory nod is a significant confidence boost for HashiCorp and the broader tech ecosystem. In the world of mergers and acquisitions, regulatory approval isn't something to be taken lightly. It's an endorsement of sound strategy and market fit, and it often spurs momentum both for the company in question and for its peers.
Now let's delve into some detailed sector analysis, starting with the technology sector, which, as we've already seen, has been at the heart of many of today's stories. The tech sphere has been under pressure lately, particularly driven by the performance of indexes like the NASDAQ. When you see key tech stocks falling below major technical indicators like the 100-day moving average, it not only raises alarms among momentum traders, but also forces a reconsideration of risk among institutional investors. That said, underlying these fluctuations is a continuum of innovation, and many analysts argue that these technical setbacks represent only temporary retractions in an otherwise upward trend. It's the classic cycle. Sometimes you have to endure a little turbulence before the engines roar back to life, much like a suspenseful movie where the hero finds strength from challenging moments.
Looking at the energy and finance sectors, we notice a different set of challenges and opportunities. Energy markets have continued to experience volatility, partly driven by geopolitical tensions and supply chain adjustments. While the details of our current energy data aren't as headline-grabbing today, it's worth noting that any significant move in global energy prices tends to have a trickle-down effect across multiple asset classes. Investors with exposures in energy stocks, commodities, and even industrial equities are much more sensitive to these fluctuations. Similarly, the finance sector is closely observing policies such as those being implemented by the Fed and moves by the Treasury. The efforts to align the Fed's maturity profile with that of government securities are here to stay, and they reinforce a regulatory push towards a more finely tuned financial ecosystem. It's almost like recalibrating the clock in a finely tuned watch. Every gear matters in ensuring smooth operation.
On the global front, the implications of these stories stretch far and wide. With major economies interconnected like never before, a policy change or corporate action in one corner of the world can create ripples across continents. Take our discussion on consumer confidence, for instance. A dip in consumer sentiment in one major economy can affect global spending patterns, influencing emerging markets and even sophisticated economies. Likewise, regulatory signals from central banks and key policy shifts in nations with dominant economic clout inevitably affect international trade and investment. When you consider the global nature of today's financial landscape, every decision seems to have an echo somewhere in Asia, Europe, or even down under in Australia.
So what does all this mean for you, the investor or trader listening today? Let's dive into some expert insights and predictions. Many of us believe that market corrections, especially those seen in the tech-heavy sectors, are often healthy. They serve to purge the system of overvaluations and inject a dose of realism into asset pricing. However, caution is always warranted when technical indicators signal continued downtrends, as is the case with the NASDAQ. The fact that it is consistently trading below its 100-day moving average may be seen as a signal to remain nimble and reassess your portfolio exposures. It might just be a case of temporary market jitters or the harbinger of a more extended bear phase. Only time will tell. As always, balancing risk with position sizing is key.
Now, regarding Tesla's sales in Europe, some experts argue that the company's decline isn't necessarily a sign of failure. Instead, it reflects a broader competitive landscape where consumer choices are increasingly diverse. I have to wonder, when did the auto industry become as cutthroat as a high-stakes poker game? With competitors like Volkswagen and SAIC Motor increasing their market share, Tesla will have to innovate beyond its current model and perhaps redefine what success looks like in a rapidly evolving market. Is this an opportunity for investors to explore equitably valued competitors, or a cautionary tale about over-reliance on a single brand?
Turn into Krispy Kreme. While the stock's trajectory towards record lows is concerning, it also opens up a debate about brand loyalty versus operational resilience. The recent fourth-quarter earnings report might be disappointing on paper, but it could merely be a momentary stumble in a brand with deep-rooted consumer favor. It serves as a reminder that even the most beloved brands are not immune to market pressures. Could this signal an eventual turnaround or more of a long-term challenge? That remains one of the more intriguing questions on the table.
When it comes to consumer confidence hitting an 8-month low due to inflation concerns and tariff uncertainties, the conversation inevitably shifts to spending power. How do these declining confidence levels translate into actual consumer behavior? Are we going to see major retailers adjusting their strategies in response to a more cautious shocker mindset? And what about the potential domino effect on sectors like housing and leisure? It's a complex interplay that underscores the importance of staying informed and nimble in your investment decisions.
Central bank policies, as articulated by Dallas Fed President Lori Logan, remain a topic of considerable debate. On one hand, aligning the Fed's balance sheet with government securities may help stabilize markets. On the other, it raises questions about the timing of such measures and their ultimate impact on liquidity and borrowing costs. This is one area where a small change in policy can ripple out to affect everything from mortgage rates to corporate bond yields. For investors, keeping an eye on these developments is crucial as they directly influence the cost of capital and overall market sentiment.
In the commodities and merger acquisition sector, Davis Commodities Limited's potential acquisition of almost 50% of Carfax Commodities Asia Private Limited is a classic example of how strategic moves can reshape market dynamics. Consolidation in this sector can lead to increased efficiency and potentially even market dominance, but it also raises regulatory and competitive concerns. It's a fascinating development that has me asking, in today's globalized world, how crucial is agility and strategic foresight in ensuring long-term success? This is an area where thorough due diligence and forward-thinking strategies will always pay dividends.
On the policy and estate planning front, the cautionary tale about the upcoming tremendous wealth transfer and the $84 trillion mess is a timely reminder that many of us need to think proactively about our financial legacies. Whether it's through better estate planning or rethinking tax strategies, the impending changes in wealth dynamics could have far-reaching consequences. It begs the question, are we adequately prepared for what might be a significant shift in intergenerational wealth distribution? It's a topic that will likely dominate conversations in financial circles over the coming years.
And then there's the child tax credit story. The notion that parents can currently claim up to $2,000 per child is excellent news for many families, though the warning that this benefit may drop after 2025 is certainly a cause for concern. It reminds us that policy changes can have immediate and profound impacts on disposable income and, by extension, consumer spending. For those planning their finances, this is yet another reason to keep a close eye on legislative developments and their potential effects on household budgets.
In the pharmaceutical and healthcare realm, Eli Lilly's move to lower the price of its weight loss drug Zepbound is as much about market access as it is about public health. With self-paying patients benefiting from a more affordable price point, the hope is that more people will have access to life-changing treatments. At the same time, the company's push for insurers and federal programs to treat obesity as a chronic disease opens up an important debate on how we approach healthcare and wellness in modern societies. This development invites us to think critically. How should companies balance profit margins with accessibility when it comes to essential medications? And what role does public policy play in mediating that balance?
Finally, let's circle back to the tech world once more, with HashiCorp's positive lift following the United Kingdom regulators' approval of the IBM deal. In an era defined by consolidation and rapid technological change, regulatory approvals serve as key milestones. They not only validate the strategic decisions of the companies involved, but also signal broader acceptance and confidence in emerging tech and cloud solutions. It's a win-win scenario for innovation and market stability, even if the regulatory processes sometimes remind me of waiting in line at the post office on a rainy day.
As we wrap up our deep dive today, let's reflect on the broader global market implications of everything we've discussed. Whether it's the tightening of monetary policy, the signaling of consumer caution, or the reshuffling of competitive positions across industries, we are living in a time of transformation. The global web of economic interdependencies means that news from one part of the world can have immediate repercussions in another. International investors must continue to look at emerging trends beyond their domestic borders, as policy changes in one region can quickly reverberate around the globe.
Now, what are my predictions? I think we're in for an interesting period ahead. The technical signs in the tech sector suggest that there may be opportunities for strategic buying, provided that investors remain patient and do their homework. The electric vehicle market in Europe, despite the temporary setback for Tesla, is likely to experience continued growth as regulation and consumer demand intersect. And while there are undeniable challenges in sectors like consumer discretionary, the overall global economic fabric remains resilient, supported by deep fundamentals and adaptive corporate strategies.
I invite you to think about a few questions this morning. In a market where technical indicators seem to clash with fundamentals, where do you see your best opportunities for growth? How do you plan to navigate the evolving landscape in a world where consumer confidence can swing like a pendulum? And what proactive steps are you taking to ensure your portfolio is prepared for both the challenges and opportunities that lie ahead?
Before we conclude, let's take a moment to appreciate the role of diligent, unbiased analysis in these uncertain times. Here at PantheonAI, we are committed to being your information co-pilot, a trusted partner to help you navigate through the market intricacies and provide clarity when things seem a bit chaotic. I encourage you to come back for our next episode tomorrow, armed with your questions and ready to explore even more market trends, policy shifts, and investment strategies. Remember, learning shouldn't feel like a full-time job, and we're here to make it as engaging and insightful as possible.
To summarize our key takeaways for today, the NASDAQ is trading below a critical technical level, reflecting broader market caution. Tesla's performance in Europe highlights the shifting competitive dynamics in the automotive industry. Krispy Kreme's earnings results remind us that even beloved brands must remain vigilant in evolving markets. Consumer confidence is taking a hit, which may have downstream effects on spending. Central bank policies and balance sheet adjustments are transformative moves that deserve our close attention. Strategic moves like Davis Commodities Limited's acquisition plans are changing the landscape in commodities, and policy shifts in estate planning and child tax credits continue to shape household finances. And let's not forget the moves by Eli Lilly and HashiCorp, which remind us that healthcare and technology remain dynamic sectors full of potential both in terms of innovation and market sentiment.
I'd love for you to mull over these thoughts as you head into your trading day. What do you think will be the dominant theme for investors in the coming weeks? Will the market see a rebound in the tech sector, or will caution prevail longer than expected? How might regulatory shifts and global economic tensions influence your portfolio in the short and long term?
Thank you for joining me on this detailed journey through today's market insights and financial news. I hope you found our discussion as enlightening and engaging as I did delivering it. I encourage you all to continue these conversations, share your insights, and leverage our AI Copilot whenever you need some timely market analysis.
Until next time, stay informed, stay strategic, and keep that sense of humor intact, because sometimes a well-placed joke can be as refreshing as a market rally. And always remember, learning shouldn't feel like a full-time job. See you tomorrow on the PAI Morning Briefing, and have a great day ahead.